TeraWulf just priced the largest note ever for a public Bitcoin miner, a $3.2 billion secured note as the AI race heats up among Bitcoin miners. This is the Mining Pod brought to you by CleanSpark. Welcome back to this week's news roundup. We've got a full docket for y'all this week. We've got the story from TeraWulf as well as another raise from Bitfarms, an upsized convertible note at $588 million. We've got a really interesting story about jet engines being repurposed for AI data centers. One of those puppies can generate about 48 megawatts, by the way, if you convert it for something like that. An update on CleanSpark hiring out a senior vice president for AI data centers. And also, Bitcoin miner debt hitting an all-time high, but this time it's different. And an update on how Bitcoin mining debt, according to our friends at Van Eck, has crossed over 20 billion as of this October. And for this week's Cry Corner, the Kadena blockchain is closing shop. This is the Mining Pod, and we'll be right back after a quick word from our sponsors. Guys, there is a serious problem right now in Bitcoin mining, and we need to talk about it. You need to pay attention to this. Bitcoin miners are identifying as AI companies, and people keep missectoring them because they say, well look, your infrastructure is clearly for Bitcoin mining. What do you want me to do about it? I'm going to tell you what you need to do. You need to call FBox, the leading digital infrastructure company with all-encompassing cooling solutions. FBox designs industry-leading air, hydro, and immersion cooling systems for Bitcoin mining and AI and HPC data centers. I want to highlight that. If you're a Bitcoin miner who needs to bridge the gap, if you're pivoting or doing hybrid operations, they can build cooling solutions and infrastructure for both your Bitcoin mining and your AI and HPC operations. And they have an in-house API that lets you monitor it from the web or on mobile. So go to www.fbox.tech/contact to learn how FBox can help you optimize your digital infrastructure today. We've got a packed schedule this week. We've got converts, because someone's always raising. The largest one ever, actually, with TeraWulf, which is pretty interesting. We've got a pretty fun story from Tom's Hardware on jet turbines being repurposed as generators for data centers. We've got an update on CleanSpark's AI front with their new SVP hire. And from the Miner Mag, Bitcoin miner debt hits a record high, but it's different this time. But before we jump into all of that, let's hop on over to Hash Rate Index, our data brought to you by our friends at Luxor to look at what's going on with Bitcoin mining data. Overall, kind of in this weird liminal space where we're waiting for either the bottom to drop out or for Bitcoin to rip. The last difficulty adjustment was negative, about 2.7%. So that gave miners a little bit of reprieve, but Bitcoin's been getting hammered. Also, we had like 7 in a row difficulty upward adjustments. So hash price is sitting below $50 per hash per day right now at about 47. And we're about 56% through the current difficulty epoch. So it looks like the next difficulty adjustment, if the current block rate, block mined rate holds, it'll be 4.7% upwards. So miners are looking at another cut of revenue almost certainly in about a week's time here. So overall, I mean, things are just not looking very good for miners right now. And, transaction fees are still completely negligible.
I'll bring in one detail which you guys never talk about here, which is an underappreciated metric on the site, Shadow Hash Rate Index, is the transaction rate over the past 7 days, 5.4 TPS. Like right now, like Bitcoin can handle theoretically maybe 8, maybe 9 or 10 transactions per second. So the actual TPS on Bitcoin is pretty solid. The problem is they're all really low value transactions, which don't really compete against each other, which is why fees are so low.
Yeah, 100%. And if you look at this, right, you can see back in 2024 when, the mempool was just popping with a lot of inscriptions and ordinals activity, we had, average network transactions of 4,873.
Yeah, and we're actually up though compared to where we were 3 years ago in terms of transactions per second. Like we're double where we were. The thing is, they're all just really, really cheap, low value transactions.
And when you say they were really cheap, low value transactions, which ones are you referring to specifically?
I'm talking about really, really, really cheap, low fee rate, usually meme coin mints, or the type of transactions we love to see, which are consolidations. If you got a bunch of UTXOs in your wallet, you can consolidate them right now for unprecedentedly cheap.
Consolidate those UTXOs, folks. TeraWulf just priced the largest, I think, as far as I can tell, the largest note in history for a public Bitcoin miner. They are looking to draw $3.2 billion in a private placement for a senior secured note due 2030 with a 7.75% interest rate. So unlike the convertible notes that we've seen other miners draw from, which can be converted into the stock into a later date at a pre-specified price or could be paid back. This is a senior secured note, so it will be backed by TeraWulf's infrastructure. And as most of these listeners will know, who know TeraWulf, this is $3.2 billion. So this is going to be plowed into their AI and HPC CapEx. It's going to be a massive capital expenditure to get some of these AI data centers off the ground at its Lake Mariner facility. And so this really is just, I think, telling to the kind of numbers that we are dealing with now, as Matt Kimmel pointed out on the pod a few weeks ago. We've kind of gotten numb to some of these big numbers, but 3.2 billion for these Bitcoin miners is more than they're used to drawing from any sort of financing or fundraising. For a lot of these data center companies, that is a drop in the bucket. But I just think it's worth highlighting that last cycle, miners were drawing hundreds of millions of dollars on loans backed by their ASICs, as we will get to in the Miner Mag article later. Now they are either drawing on these convertible notes, or as we've seen with TeraWulf now, they are taking their big boy infrastructure, their data centers, and using those to secure lines of debt. This is something that I have been asking, analysts, investors, and Bitcoin miners for a long time. When are we going to see miners have access to capital at cheaper rates than we've seen them historically? 7.75% is still not great, considering that's pretty high compared to historical averages, or at least zero ZERP policy averages that people have become accustomed to, right, over the last few decades. But it's a heck of a lot better than the double digits that they would get under these ASIC financing loans.
Yeah, I mean, 3.2 billion is super high for a Bitcoin miner. It's, I would say, par for the course for these hyperscalers. You do love to see the Bitcoin miners manage to actually evolve the note process. Like, that's what blew a lot of these miners out and caused like Core Scientific, like they had a convertible note, but that's what drove a lot of their bankruptcy woes last down cycle. But now miners have like real infrastructure, and we're not backing it with ASIC prices, which are much more variant than I imagine a lot of like the actual real infrastructure components. So shout out to TeraWulf. There's a lot of really sharp people over there, and this could be one of those companies that really dominates over the next decade.
Yeah, they're certainly emerging as one of the front runners in the AI and HPC pivots for Bitcoin miners. I think this year, we're starting to get a clear indication of, I think, like there are about, I would say, 8 or so companies out of the top miners that have shown themselves to be like very seriously looking into these business lines. And then next year, we're going to see these companies separate themselves, I think, into like top 5, top 3 that are actually going to be sustainable long term. Speaking of one of those that is emerging as one of the more serious contenders, Bitfarms also out with news this week of a upsized $588 million convertible note. They've exercised an $88 million option for this, for a total contingency of $588 million. They will net $568 million from this note. It's due in 2031 with a 1.375% coupon attached to it. Not too much to say here. Obviously, this is much smaller than the 3.2 billion, but it's different. It's a convertible note versus TeraWulf's secured, and it's just another indication that, as we will see later with the Miner Mag article, these raises are just becoming a weekly occurrence, and we're going to need to see a lot more of them too if these miners are going to execute these AI pivots, because the CapEx expenditures are going to be spectacular.
Yeah. Shout out to Bitfarms. They pivoted fully. They pivoted hard, and they appear to be leading the pack. I mean, they're one of the smaller ones by like overall megawatt footprint. At least they were for mining. Entirely possible they could become one of the leaders across the board for the AI pivot.
Yeah, they're one of the more interesting ones in the sense they actually own a coal-fired power plants in Pennsylvania. So if they can actually get tenants and stand up a PowerShell, then they are going to have so much leverage with that because they're vertically integrated on the power source. They can be very creative in terms of how they structure the costs for those facilities, I would imagine.
Yeah, and just like listen to like AI bulls, which I think are still directionally right. Like there's an infinite amount of dollars and a limited amount of megawatts. So that's the math for the foreseeable future.
We are CleanSpark, America's Bitcoin miner, a publicly traded company with the largest operating hash rate, powered entirely by self-operated infrastructure across 4 states. This is our proof of work, and we are setting the standard for what's next. Learn more about the intersection of energy and Bitcoin at CleanSpark.com.
All right, we will move on to probably the pulpy story of interest for this week, which is this
is a cool story.
This Tom's Hardware article, and it validates something that we actually heard at NABS, which we'll get into in a second. But the headline here says data centers turn to commercial aircraft jet engines bolted onto trailers as AI power crunch bites. So faced with multi-year delays, I'm quoting directly from the article here, to secure grid power, U.S. data center operators are deploying aeroderivative gas turbines, effectively retired commercial aircraft engines bolted into trailers to keep AI infrastructure on lines. So these are jet engine turbines, can produce roughly 48 megawatts apiece. And this is coming as these data centers are scrambling for power anywhere they can find it. Every time I talk to someone working in the oil and gas industry, they say one of the biggest trends right now are data center companies gobbling up generators, gobbling up turbines, and trying to find a way to get those on site to get as much power as possible from any place that they can. And this validates the fact that there's a huge supply chain crunch right now for all of these parts. I mean, we've talked to miners and operators say everything from like switchboards to transformers are in short supply right now because of the AI and data center boom. And we heard at NABS, the North American Blockchain Summit, when we were there a few weeks ago, we were talking to a Bitcoin miner or a data center operator. It's funny. It's like you can't, at this point, they're kind of one and the same because everyone's trying to do both. But this operator was telling us that he was running the numbers the other day and wondering what was the value of JetBlue based on these engines alone, and saying you could buy up JetBlue just to get.
So in between that and now, we saw like some of these airlines catch a bid because of this story. I forget who it is. There's that one that starts with an S.
Spirit.
Maybe JetBlue caught a bid. Spirit caught a bid because of it. Like literally because of like this was a driving story. And I mean, who manufactures it? Doesn't like Rolls Royce make a lot of these? Like, what's funny is like I hear like the data center play isn't just AI companies; it's like everywhere. So like the AI boom is like affecting everybody. So maybe it was Spirit.
Yeah, here's Spirit. Spirit's market cap is $9 million. I mean, that's kind of crazy, right? How many jets do they own? The value of the jets, do they not own their jets? Like you'd have to think that some of the infrastructure that they have would be worth more than that. Let's see what JetBlue is doing. JetBlue is a little harder fish to swallow there. It's a 1.68 billion. It's really obviously interesting to get a story like this because it's pulpy and it's fun, but it just goes to show you how difficult some of the real world problems are when standing up infrastructure like this, and how creative the companies can be at solving them. And also, it goes kind of to the butterfly effect in a way. An electronics maker in Malaysia gets slapped with 25% tariffs or goes offline, and all of a sudden a data center is put back a few months for deployment.
I have a couple other comments, which is I'm not really familiar with this type of engine, but like, are these things going to be used as like primary power? Or are they going to be running like?
No, I don't think so. So some of them will be used for redundancy, I would imagine, because all these data centers have to have backups. And natural gas generators are and diesel generators are like the only solution to that right now.
Gotcha.
Or they will be used as a kind of a stopgap. So like maybe they need just a little more juice before they can get something else online.
failover. They can handle like the marginal load. And I mean, these are not that efficient. Like, especially if you run these things. I was reading the article and it kind of validates what you would intuitively know, which is these are engines designed for airplanes, not like to be run as continuous efficient generators for data centers, like base load. So these things are not going to be that efficient. It's funny, like we're so starved, we're going to go really far down the efficiency curve. And, what's next? Lawnmower engines? I don't know. The environmentalist criticizers are going to have a field day because you know those numbers about like taking a trip across the Atlantic, flying across the Atlantic destroys like 20 humans worth of food energy. This is going to be like, you thought OpenAI ecological footprint was bad before. How about now?
Yeah, exactly. It's going to be like every time you generate a Ghibli image, you're burning 1,000-mile trip across the Atlantic. All right, let's move on to our next story. As always, something to do with AI and HPC, and that is CleanSpark hiring out for a senior vice president position for data centers. So CleanSpark recently hired Jeffrey Thomas as senior vice president of AI data centers. He comes to the company from Humane, where he served as president of AI data centers and oversaw Saudi Arabia's multi-billion-dollar data center build-out program for AI. So this is one of the more consequential news items for CleanSpark to come out in terms of their AI and HPC line. Recently, a few months ago, we saw a leadership change with Matt Schultz taking the helm as CEO, as Zachary Bradford stepped down, and then CleanSpark subsequently announced that they were going to be looking into converting a data set, or not converting, but looking into AI and HPC data loads for some of their data centers or for prospective sites in the future. They have not announced anything in terms of any partnerships or anything like that, so the market is still waiting for that. But this was the first big announcement for them, I think, to show that they're very serious about getting into this. So not too much to add onto that, other than CleanSpark will be one to watch to see if they strike any deals over the coming months.
CleanSpark is the second to last major Bitcoin miner by hash rate, which pivots to AI. That leaves just Kango, I believe, in the
and kind of Mara. Mara is
Mara,
they say that they're gonna partner with sovereigns who are doing AI compute and try to do Bitcoin mining stuff in tandem with them. It's actually very vague, but really to your point, Mara and Kango have 50 exahashes. CleanSpark has over 50 exahashes. Or Mara has over 50 exahashes at this point, and these three miners are the three big miners next to Iron, and they haven't really had a big announcement for AI yet.
Yeah. So I know the pivot to AI has worked out really, really well for pretty much everybody in the mining space. So CleanSpark officially joins the fray.
Yeah, it does seem at this point that it's a matter of, obviously, you have to give your hats off to the teams who have executed these deals. But if you can get the right team around you, knows what to do and knows who to talk to and has the right connections, there's a good chance that many of these miners will be able to find someone to work with them as long as they don't screw it up royally, right? I mean, if you just look at the appetite for these data centers versus how much energy there is to go around, the math kind of works itself out. But we will move on to our final story of the week, kind of adding on to the first two stories on TeraWulf's senior debt and senior note and or secured note and Bitfarms convertible note. This is from our friend Wolfie Zhao at MinerMag. Bitcoin mining debt set for new records, but this time it's different. I'm going to pull up a chart in a second, but to quote from Wolfie here, the combined debt and convertible note offerings from 15 public miners hit a record $4.6 billion in Q4 2024, briefly reduced to under 20 million or 200 million in early 2025, and has since roared back to 1.5 billion in Q2. And I believe when he says reduced, I think he means that the raise is calmed down. I don't know. Maybe he's saying that some of this debt was all paid back, but a lot of that was convertible debt, which wouldn't necessarily be paid down yet. But if we hop on over to this chart from Matthew Siegel, he contextualizes it further. Total Bitcoin miner debt has eclipsed 20 billion as of mid-October, according to Van Eck estimates, which is just an absolutely staggering number and something that we wouldn't have expected a few years ago if it hadn't been for these AI pivots. Because if you look at the balance sheet of a lot of these Bitcoin miners and you look at their fundraising, what they will typically do is like they've always leaned on equity because it's the easiest way for them to raise. They will dilute their shareholders, sell equity, and deploy that into CapEx to expand their operations. Because they haven't been able to access debt, like I said earlier, at favorable rates. Now, investment banks are willing to offer them convertible note, or willing to roll out the carpet for convertible notes. As we saw with TeraWulf, they're able to secure notes with their data centers. So now they have access to capital instruments that are much more capital efficient. They don't have to worry about dilution as much. And so we're starting to see them take on a lot more debt. But this mushrooming would not have happened without the AI and HPC pivot. And just one last thing to highlight. Last cycle, the debt that miners did have, and it was scant. Some of them secured credit facilities with like Coinbase or Galaxy with their Bitcoin holdings. Very few secured credit outside of that. That wasn't ASIC, that weren't ASIC backed loans. Core Scientific famously had a bunch of debt that was not ASIC collateralized by their ASICs or collateralized by Bitcoin. And, they went bankrupt in 2022. That wasn't just because of the debt, but they expanded pretty aggressively. But these miners would typically do ASIC-backed loans because that was one of the only ways that they could finance it. They would go through either Foundry or NYDIG or Ant Alpha. And, these were horrible instruments for any miner for anyone who knows how they were structured knows that they ended up being catastrophic because these ASICs are highly volatile. They depreciate very quickly. And when hash price takes a dip, as it did in 2022, when Bitcoin started cratering, then these loans were defaulted on, and they kind of created this cascading event. And then the lenders who lent the money are now find themselves with ASICs that are worthless and can't really produce much because Bitcoin is crushed and hash price is also crushed. This was all exacerbated by the fact that 2021 created this complete gold rush splurge environment in the US because China just banned Bitcoin mining. Hash rate got cut in half, difficulty got cut in half, Bitcoin mining was ripping, so it was incredibly profitable to mine Bitcoin. The ASIC market was distorted as a result, and these ASICs were wildly overpriced by the end of 2021. Like an S19 was going for $12,000 at the peak. And so some of these loans were collateralized with ASICs bought near the peak, and so the rest is history. A lot of them were defaulted on.
I mean, the miners didn't have an option at the time. There was like no other way to get money. So they just went with, there was just one game in town. And it was just really poorly structured, setup. So now it seems like debt can be used to grow companies. These types of notes and leveraging your infrastructure is a common way for companies to grow and take on debt so they can inject more money in capital. But so this seems like the modern evolution of that is improved. The market, time will tell. To me, it seems a lot more sane than last cycle. So, but we'll see.
These instruments are much more mature than what miners have accessed in the past. And so I would imagine investors are much happier seeing this type of debt versus what we've seen in the past. But we'll leave that where it is and we will move on to this week's Cry Corner.
The Cry Corner.
Which is the Kadena blockchain is shutting down. Now, for miners who don't know about Kadena, let me get this tweet up. It was a blockchain launched. I'm going to get in trouble here because I actually haven't looked into it too much, but I assumed that it was launched.
But Paul, there's nobody to give you trouble. They're out of business.
Well, it's like one of these coins that was launched kind of in partnership with Bitmain, and Bitmain built an ASIC for it. The first time I heard about this ASIC was when I was at the World Digital Mining Summit in Hong Kong in 2023, and they were launching the Kadena miner. Like it was it's like a Litecoin miner where it's like it was like tens of thousands of dollars to buy one. It was crazy expensive, largely because with these altcoins, supply and demand is so wild because the hash price on these things is crazy because there aren't that many people mining it. And so miners could actually mint a pretty decent coin for mining this thing. If they were close enough, I guess, to Bitmain to get a decent discount on those rigs, but this was a coin that was launched in apparently I didn't know this 2021. So
yeah, back pretty far.
So
actually.
I guess I should retract what I said. I don't know if Bitmain is related to it, but they launched a miner for it, and I don't know why they would go out of their way to launch a miner for something unless they had, obviously wild financial incentive to do so. In 2023, after the other miner launched, it had a brief run up to almost $2, and now it's piddling at about 6 cents. So what was this blockchain used for? I have no idea.
Nope. Doesn't matter.
Other than mining suckers. That's the only thing.
Look, I'm going to get us canceled multiple ways here. Bitmain's always looking to sell more ASICs. So if there's a hot new fancy proof of work blockchain, remember, 2020 was not a cool time to launch a proof of work chain. So, any material thing that comes along and says, Bitmain, make us an ASIC, they'll do that, and they'll do preferred deals and distribute those. But the real issue, Colin, is that there can only be one shitcoin proof of work chain that starts with a K. And Kadena's out of fashion. Now it's Caspa. I'm going to get absolutely eviscerated for that. So, it's pretty clear. The grift goes from K blockchain to K blockchain to K blockchain, and Caspa's the hot. I use a different term, altcoin, alt proof of work coin, to mine right now. So, yes. Caspa, buy your overpriced Caspa miners. Give the money to Bitmain. Give McCree more money.
Don't buy these miners.
Don't buy those miners.
Alrighty, we will leave it at that. Appreciate y'all tuning in. Everyone have a beautiful weekend, and we will see y'all next week for a mining pod and another mining pod roundup. Peace and love, y'all.